It seems simple, right? If fewer people are looking to rent, prices should fall. That's how supply and demand are supposed to work. But lately, that rule feels broken. In cities from New York to Austin, from London to Toronto, rent keeps climbing even as vacancy rates rise, listings sit longer, and demand cools off. So what's really going on? Let's unpack the hidden forces behind stubbornly high rents, because it's not just about demand anymore. Let's start with what's visible, the numbers. In the US, national median rent hit about $1,964 in July 2024, according to Realtor.com. That's down a few dollars from a year earlier, but still about 23% higher than pre-pandemic levels. In some metro areas, like Miami, rent has jumped over 35% since 2019. Now here's the twist. Vacancy rates have actually ticked up. Moody's Analytics reports that the national apartment vacancy rate rose above 6%, the highest in nearly a decade. Normally, that should mean landlords lower prices to fill units, but many haven't. Why? Because the cost of being a landlord has changed dramatically. Let's talk about the first big factor, supply costs and financing. During the pandemic, building materials skyrocketed in price. Lumber tripled in cost between 2020 and 2021. Steel, cement, and copper rose around 30 to 50%. Even though prices have eased a bit, they're still well above 2019 levels. Developers also got hit by higher interest rates. In 2021, a developer might borrow at 3%. By 2024, that same loan could be closer to 7%. That means every new apartment building or renovation project now costs far more to finance. Higher construction and borrowing costs mean landlords need higher rent just to break even. Even if demand softens, they can't drop rents too far without losing money. And here's something most renters never see, the math behind a landlord's decision. Say a small landlord bought a duplex in 2020 for $500,000 with a 3% mortgage. Their monthly payment might be around $2,100. If they refinance or buy today at 7%, that payment jumps to nearly $3,300. That's a $1,200 difference every single month. So when new landlords enter the market, they have to charge more rent just to cover debt and taxes. That sets a new floor for prices across the area. Now, another piece of the puzzle, insurance and maintenance. In many parts of the US, property insurance has exploded. Florida is the poster child. In 2024, insurance premiums there rose by more than 40% on average, driven by hurricane losses and insurer pullouts. California saw similar spikes due to wildfire risks. Even in less volatile states, premiums have risen 15 to 25% since 2020, and property taxes are following the same path. When home values surge, tax assessments rise too, pushing costs higher. Landlords pass those increases straight through to tenants. It's not greed, it's survival math. Then there's maintenance. Labor shortages in construction mean plumbers, electricians, and HVAC techs are charging more. A repair that cost $500 3 years ago might be $800 today. Multiply that across dozens of units and the pressure adds up fast. All of this means landlords can't afford to cut rent easily. Even if demand dips, their expenses don't. But there's another, quieter force, the structure of leases and renewals. Most tenants sign year-long leases. That means rent adjustments happen gradually. If a renter signed at peak prices in 2022, they might still be paying that rate today. So even if new listings drop a little, the overall average rent stays high because millions of existing leases are locked in. And landlords rarely reduce rent for renewals. They just freeze it or raise it slightly. Few tenants move out to chase lower prices, especially when moving costs thousands. That inertia keeps the market sticky on the way down. Think of it like a thermostat that heats quickly but cools very slowly. Rents spike fast when demand is hot, but they barely budge when things cool off. Now, let's add a different layer, corporate ownership. Institutional investors, big firms that buy thousands of homes or apartment units, now control a growing share of the rental market. In 2010, they owned less than 1% of single-family rentals. By 2024, that share has climbed to around 3.5%, with firms like Invitation Homes and Progressive Residential leading the pack. That might sound small, but in some metro areas, they own 10% or more of available rentals. These companies use data-driven pricing algorithms that optimize for profit, not occupancy. If the algorithm says a 5% vacancy is more profitable than a 2% vacancy, they'll choose the higher rent. That keeps prices elevated even when demand softens. It's not personal, it's math, but it changes how the market behaves. Instead of thousands of individual landlords adjusting prices independently, we get centralized pricing strategies that resist downward movement. Now, let's zoom out and look at housing supply overall. Economists estimate the U.S. is short about 3.2 million homes, according to Freddie Mac data. That shortage isn't disappearing just because demand dips temporarily. Even if fewer people are renting today, there still aren't enough affordable units in the right places. Construction has slowed sharply since rates spiked. New housing starts dropped nearly 15% year over year in early 2024. Developers are delaying projects or canceling them entirely because financing costs have gotten too high. And that means fewer new apartments will come online in 2025 and 2026, keeping supply tight. So when demand eventually rebounds, rents will rise again even faster. It's like holding down a spring. The pressure builds quietly until it snaps back. But here's where things get more complicated: geography. In some cities, demand really has fallen. Austin, for instance, saw a surge in new apartments, more than 30,000 new units in 2023 alone. That led to small rent drops in early 2024, maybe 2 or 3%. But at the same time, cities like New York and Chicago saw rents climb another 5 to 6%, despite slower population growth. That's because local supply and policy matter more than national averages. In New York, strict zoning and limited land mean developers can't build enough to relieve pressure. In Chicago, property taxes on multifamily buildings rose almost 20% in some neighborhoods, offsetting any chance for lower rent. So even if demand cools, these structural bottlenecks keep rent from falling meaningfully. Now let's talk about demographics, one of the quiet drivers of the rental economy. Millennials are now the largest adult generation in the US, and many are still renting. At the same time, Gen Z is entering the market in big numbers. More than 4 million Americans turn 25 every year, the age when most start renting their own place. That steady pipeline of new renters keeps a baseline level of demand even when the economy slows. Meanwhile, some older renters are staying put longer because downsizing or buying is no longer affordable. The median home price in 2024 is around $420,000, and mortgage rates hover near 7%. That pushes many would-be buyers back into the rental pool. So even when job growth slows or migration patterns shift, there's a constant undercurrent of renters who simply have no better option. And that leads us to a deeper issue: the affordability trap. When rents rise faster than wages, people can't save for a down payment. That delays homeownership, which keeps them renting longer. It's a feedback loop that traps millions in the rental cycle. In 2024, the median renter household spent about 30% of income on rent, according to the Harvard Joint Center for Housing. For lower-income renters, that figure jumps above 50%. That leaves little room for savings or upward mobility. Landlords, meanwhile, face their own version of the trap. They can't lower rent much without losing cash flow, and they can't sell easily because high rates depress property values. So both sides are stuck. Now, you might wonder, if demand falls, why don't landlords compete harder for tenants? In some markets, they do, but competition often takes the form of incentives, not lower rent. You might see offers like 1 month free or free parking for 6 months. That way, the advertised rent stays high, which helps preserve property values and future appraisals. It's a psychological trick, but it works. In the data, the rent looks unchanged, but the effective cost to tenants drops slightly. That's another reason why national averages may not tell the full story. Another subtle factor is regulation and rent control. Cities like New York, San Francisco, and Los Angeles have strict limits on how much rent can rise for existing tenants. That sounds good for renters, and it can be, but it also discourages landlords from renting units below market rates or investing in maintenance. Over time, some units leave the rental market entirely, worsening supply shortages. In places without rent control, landlords feel pressure to raise rent while they can in case future regulations cap their flexibility. It's a game of preemptive inflation. Now, let's not forget the role of migration and telework. The pandemic reshaped where people live. Some cities boomed, others emptied out. Even now, remote work allows millions to move to cheaper areas, but when they do, they often push up local rent there. Think of Boise, Idaho, or Tampa, Florida, where rents rose 30 to 40% between 2020 and 2023 as remote workers arrived. So one region's falling demand might simply be another region's surge. National demand might look flat, but the local picture is much more uneven. There's also a psychological side: expectations. After years of headlines about soaring rents, landlords have grown accustomed to the idea that prices only move one way. They set rates with that mindset, assuming tenants won't push back. And often, tenants don't, because they fear losing the unit or facing even higher prices elsewhere. That lack of downward pressure creates what economists call price stickiness. It's the same reason gas prices fall slower than they rise. Once consumers adjust to a higher baseline, it becomes the new normal. So when we ask, why is rent still rising even though demand is falling, the real answer is the system itself has changed. It's not just a simple supply and demand curve anymore. It's a web of costs, expectations, and structural constraints that keep rent elevated even when fewer people are searching. Now, what could actually bring rent down? In theory, three things: more supply, lower costs, or a major economic downturn. The first one, more supply, is the healthiest path. Cities that make it easier to build, like Houston or Charlotte, tend to see more stable rent growth. Houston, for instance, added nearly 20,000 new apartments in 2023, and its rent growth was below the national average at just 1.5%. Zoning reform, streamlined permits, and incentives for affordable housing can all help, but those changes take years to show results. Lower costs could help too, if interest rates fall or if insurance and materials stabilize, but that's largely beyond local control. And the third path, a major recession, could force rents down, but at a steep price. Job losses would hurt both renters and landlords. Nobody really wins in that scenario. So, the likeliest outcome, rents might stop rising fast, maybe even flatten for a while, but large drops are unlikely unless something big shifts. That's why understanding these dynamics matters, for renters trying to plan, for investors making decisions, and for policymakers shaping the future of housing. Because the old rules of supply and demand don't tell the full story anymore. We're living in a world where costs, constraints, and expectations weigh just as heavily as consumer demand. So, next time you hear that rent should be falling but isn't, remember, it's not just about how many people want to rent. It's about how expensive it's become to offer a place to live. If you found this breakdown helpful, don't forget to subscribe to Taz Money for more deep dives into the real forces shaping our economy. Because the story behind your rent check says more about the world than you might think. And as long as those forces remain in play, high costs, tight supply, and sticky expectations, the rent, it seems, will keep rising, even when demand doesn't.